Meantime, how might those moves in oil's prices and bond yields affect the stock market today? Let's bring in Jack Ablin. He's Cresset Capital's founding partner and CIO. Jack, good to see you. Obviously, we have green across the screens for now. What's the significance, you think, of the drops in bond yields, the drops in oil? How big of a deal are they?
Yeah, I think it's a really changing narrative. I think finally, at long last, investors do see light at the end of the tightening tunnel. We are starting to see evidence of consumer slowdown, of economic slowdown. We're seeing inflation abate. So I think all of these signals suggest that interest rates obviously have come down from that 5% peak down to well below 450. And we expect slowing as a result. Meanwhile, of course, earnings estimates still hold pretty well in place. And that's part of the reason why we're seeing equities do as well as they are this month.
Does it keep going?
I think it can. I mean, at some point, of course, a slowdown becomes a victim of its own success, so to speak. And if earnings do start to deteriorate, and one of the things I point out in a piece I sent out to clients today was if you look at, for example, same-store sales, and you could pick whatever retail you want, but essentially the same-store sales growth that we've seen over the last year is pretty much matched inflation. What that really means is there's no volume growth, and that all of the revenue increases that a lot of retailers and other companies have enjoyed over the last 12 months was pure and simply pricing power. Well, if now prices roll over and we see that downtrend, that could start to hurt earnings and profit margins.
I wonder, too, in that case, if that lends you kind of to one part of the market in particular over another.
Well, I think for right now, I would say healthcare is probably pretty well insulated from the vagaries of the economy. They've tended to lag, and these are high quality companies. So we're not really looking for companies that have to refinance debt, for example. These are also companies, Medtronic, Ecolab, AbbVie, have not only strong dividends, but strong track record of dividend growth. So, for example, Medtronic, 3.5% dividend yield. It's been growing its dividend at an annual rate of 7.4% annually. Ecolab, 1.1% dividend, but it's been growing its dividend at a 5.3% annual rate. And then lastly, AbbVie, 4.5% dividend yield, growing its dividend at a 10.5% annual rate. So probably in an environment where as interest rates come down and things start to slow, high quality growth companies that can pay shareholders pretty healthy and increasing dividends could be a good place to be.
When does investing for a dividend turn into chasing a dividend?
Well, I think that's the difference between quality and yield. So, for example, while dividends have been probably one of the least worst performing areas of the market this year, wasn't because, they're really for two reasons. One is high dividend stocks tend to be bond substitutes. And now that bonds are able to, fight at their own weight, so to speak, because of the Fed, a lot of would-be dividend owners have now shifted back to bonds. But the other part of the high dividend companies is they tend to be lower quality. They tend to have higher debt. And as this debt starts to roll over, that's going to eat into their financial position as well. Whereas dividend growers, lower yields, higher quality companies, less debt, and have a good, strong track record of growing that dividend, not just over time, but well in excess of inflation over time.
All right, Jack, thank you very much. Jack Ablin, we appreciate it. Have a good holiday.
Thank you, Tyler.
You bet.